Just out of curiosity, who doesn't know what a CDS is? Okay. I only found out about 10 minutes ago. Okay.
Yeah. All right. Yeah. I was gonna mention that a little bit later on. I probably should have done it earlier, but a credit default swap, and I'll get to that right now. Just a few CDS basics. A CDS contract is essentially credit insurance. It's not insurance though, because banks and brokers and hedge funds aren't allowed to traffic in insurance, and there's been some regulatory discussion around this. But it looks, feels, and smells a lot like insurance. A premium is paid for credit protection on a specific asset to protect against specific events over a specific period of time. Generally 5 years, but you can make bespoke CDS sort of deals, as much as you want. It is not insurance though, and the reason it's not insurance is because it's settled with an asset swap at the conclusion of in the event that there's a trigger. It's settled with an asset swap as opposed to simply an insurance payment. The market experienced parabolic growth over the past.
By the way, I'm sorry, just to back you up, is it always the case that a CDS is settled with an asset transfer?
It's generally the case. It can be done. You can also do a cash settlement as well.
So that if you have people who go out and buy credit insurance, I know you guys don't like to use the word insurance because then some insurance regulator looks at you cross-eyed. But okay, so you write the CDS. For somebody who's worried about the risk of GM's bonds having a triggering mechanism. At the end of the day, I don't need to own General Motors bonds to go out and buy collateralized debt service recovery, do I?
Nope.
So in the event of a triggering event, if there's more people holding the credit derivative than there are people holding the bonds, it'd be a son of a bitch to have to settle that with property, right?
Well, and almost by definition, in any widely traded name, there's way more notional CDS than you could ever settle.
Multiples, and so what ends up happening is you have there generally in a case like General Motors, for example, or Lehman, there were multiples of notional CDS above and beyond the sort of basis, and what you do is you have you get sort of a variety of interested parties together. You have an auction on the recovery value of the underlying asset. It might be sort of senior debt exposure. You have an auction as to what the recovery value of that is, and then the physical bonds, I think, are actually able to be sort of passed around from party to party to party and presented to the various counterparties in exchange for payments.
So Lehman ended up at the auction at what, 8.5 cents, something like that?
I think it was lower than that. It was like 2 cents or something.
No.
It was
We're
low.
going to do much better than 2 cents.
You might do much better, but the auction settlement was very low.
Gotcha.
I mean, for those of you that, like me, are, we're not fancy investment bankers or even consultants. I mean, all we do is practice law. But the implications for us in our bankruptcy practices, when at the outset of a case like a Lehman Brothers, you have an auction. And again, the concentration of people that are involved in this, you just heard, is pretty dramatic. I mean, 30% of all of it is done by hedge funds. The balance of it is done by banks. What you didn't hear is about 3 banks that control most of that. So you're talking about a grand total of 4 or 5 guys get in a room, conduct an auction, and set a price. So for Lehman, somewhere between the 3 and 10 that they're talking about, well, how does that affect you if you're counsel to a general unsecured creditors committee and the case has just begun and you've got lots of really good arguments about why the unsecured claims ought to ultimately fare well? All of your typical sort of arguments about how the going concern value of the business is going to change. You've got claims and causes of action that you're going to pursue. You're going to get to knock out all of the liens, claims, and encumbrances by the senior secured lenders, who are all bad guys to begin with. If the auction has already set a value of 10 cents, can the judge just say, well, look, take a hike. The case has started, and I've already got a price for what general unsecured creditors ought to be worth. When you talk about the roulette wheel and who's a winner in CDS, while I agree with you, generally speaking, we don't know who wins or loses. I think you can place your bet, luckily, on litigators generally, and maybe even bankruptcy litigators specifically, as to who's going to win when CDS starts, to impact virtually every large restructuring, even more so than it's done to date.